Well, thank you all for joining us all the way in the end of the hallway. You made it past Jane Goodall. You made it past about 15 other amazing sessions to be here, so we're very thankful that you made it and you're starting your week with us. I'm Christopher Lee. I'm a director of the Center for Financial Markets at the Milken Institute, and I'm very excited to have this panel because it's an acute example of a broader recurring theme at Global Conference, and that is the role of finance in creating stronger societies. And impact investing does that explicitly by blending financial and social returns. And so we've assembled an eminent group of folks from the field today to share their wisdom. And I know you've got biographies and pictures in your hands, but if we just kind of go down the road, maybe 20 seconds each, just introduce yourself. Dave?
David Bohigian with the Overseas Private Investment Corporation. Prior to that, had worked at hedge fund, investment bank, private equity, as well as venture capital, and was the Assistant Secretary of Trade in the Bush administration.
Hi, I'm John Buley. I'm a professor of finance at Duke University, and prior to that I spent 25 years or so in JP Morgan Chase & Co.
Good morning, everyone. I'm Anne-Marie Griffith, Managing Director of Fixed Income at APG US, and I have a background in corporate portfolio management.
Great to be here. I'm Jim Sorenson with the Sorenson Impact Foundation. And I guess my history is pretty much as an entrepreneur and then ultimately as an impact investor.
I'm John Streur. I'm the president and CEO of Calvert Research and Management, one of the larger shareholder engagement and investment firms in the world. And I'm also happy to be a director of Calvert Impact Capital, an entity that does direct lending to high impact causes throughout the world.
So this is the center of the universe for impact investing today, for those of you who don't know that. And this is a burgeoning field. It's grown in terms of assets under management by about 2.5 times over the last 5 years, and it's a highly diverse and dynamic field. Some folks are calling this the Silicon Valley of finance, which can be good or bad depending on your perspective. But it's tinkering, it's reinventing, it's upgrading. And so we took the liberty of boiling down this highly diverse field to frame the hour. So I think we've got one slide that we could put up on the screen. And for you aha slide folks, we realize this is not as prophetic as Stephen Hawking's theory of everything, but it's a simple kind of distillation of how to get involved from the investor's perspective based on their desired level of engagement. So on the left, you'll see a category we're calling non-discretionary approaches. And examples here would be mutual funds that are screened for environmental factors. These are products that are built on the existing financial markets infrastructure, so they're scaled, they're cost competitive, they don't require a lot of work on behalf of the individual investor, but you're a couple layers removed from the direct impact. In the middle, you'll see we've got something called discretionary via third party. And examples here would be private equity vehicles that are more tailored. For example, a private equity fund that is targeting last mile health in 2 countries. So you've got something that's kind of more controlled from an impact perspective, more direct, but also more intense and more costly from the investor's perspective. And on the far right, the most intensive approach to getting involved would be the direct investment category. You'll be building a social enterprise yourself. You'll be funding it directly. So you've got the most control. You got the highest attribution from an impact perspective. Your name may be on the door in this situation, but it is the most intense category. And so for the hour, we're not seeking to make judgment calls. This is not a kind of a values discussion. And it's not to say these are mutually exclusive. I mean, we recognize that people and portfolios are multidimensional. You could be involved in a medical research business, and you also want to tune your portfolio to climate change. So over the course of the hour, we're going to touch various points along this continuum. But before we did, I wanted to go to Jim, who's been an early and influential advocate for impact investing. And Jim, maybe you could just help us kind of understand why you came to this field, why it's been important to you, and how it's changed over time.
Thank you. Again, I think it's a real privilege to be here with everybody on this panel. And my story is, kind of comes from the business side rather than the philanthropic side. I've been an entrepreneur for really all of my life. And one of the businesses that I founded was a business that ultimately addressed really a profound social need in the deaf community. It enabled the deaf to communicate with the hearing through a remote sign language interpreter over the internet. And the crucial, or really critical thing about it was that it changed their capabilities. They were able to better compete with their hearing peers because the communication was in real time. And I learned that a business could address a social problem. And I think the real aha moment for me was that it could, in a much more scalable, self-sustaining way, because it was able to essentially generate a profit to be able to reinvest in the business. It was able to access financial resources that may not normally be available to social businesses. And it had a discipline and a transparency and accountability that quite often is not found in other models in philanthropy. And this really led me on the path to be looking for other models that it could apply this same type of approach to addressing social problems. And as I was looking to give back, then I focused on impact investing, and then found that through philanthropy that I could be very involved in the very early stages of impact investing, making higher risk direct investments, providing grant capital to organizations that were helping to build an ecosystem or fulfill a need that would help to promote and facilitate impact investing, and in general, a more and different approach to addressing social problems.
Yeah, I mean, so you raise a couple important points there. One, that philanthropy and direct investment can help build new markets. I mean, you may be way out in front of anything that's ever existed before. And I guess you've got our motor running a bit, and so I want to start to travel across our continuum and talk about a couple examples that are built on top of existing markets. And John Streur, I'd like to come to you first and get your take. Calvert Research and Management for years has been a leader in kind of specialized approaches to public markets products for impact. And so tell us a little bit about how those products are structured and how you're layering in impact factors on top of financial factors.
Sure, thank you. And as Jim said, it's a privilege to be here. Thanks everyone for your interest in this important topic. The way Calvert's products are structured, we are on one hand, a mainstream investment management organization. We work across the global capital markets on the public side, public equity, public debt, globally. So in terms of the returns that we work to create, the structures that we provide, we look like any other investment management firm. The difference is regarding what's on the inside. There are two major differences. One, we do deep research company by company to understand the impact that any company is having on society and on the environment. We factor that information into a risk analysis. So there are some companies that we simply don't own because we think they're too risky in terms of their social and environmental impact. But then the second thing that we do that's very different is activism. We engage sometimes aggressively with company managements as share owners in an effort to get companies to change. Of course, we carry that through our proxy voting. We build coalitions of other investors, and we go after specific issues where we see an intersection between business and social and environmental outcomes. And one of the things that's really changed that I think is worth talking about is the effectiveness of that kind of engagement. 10 years ago or so, I think there was a viable question, does this work? Can you come at a company and ask them to change their practices in ways that create better outcomes for people in need or better outcomes for the environment? I think it was a viable question 10 years ago. That situation has changed quite a bit. So today, when we engage with company managements, about 50% of the time, we're able to get a company management to do what we think they should without having to go to a more aggressive posture. The more aggressive posture is filing a shareholder resolution and possibly getting into a proxy fight with management. We do that in about half of the occasions. Today, after we file, most of the companies come to the table and negotiate a successful outcome. The reason for this is we have company. Lots of large investors understand the need to get companies to do a better job in terms of creating well-being for more and more people and addressing environmental needs. Secondly, our data today is much stronger than it's ever been. So our ability to use large volumes of data and come to companies, explain to them the business case for making a change, helping them understand the role they play in overall economic development, the critical need that they have over the long term to create better outcomes, particularly for poor people or disadvantaged people. This is working. So that's in a nutshell what we do at Calvert. Certainly we have more and more company in terms of doing this work. Today, large asset managers are coming into the space. So we have been a pioneer and a leader. And I think where we're really moving forward today, in addition to the investment activity, is the aggressive engagement to try to get companies to create positive change.
I mean, so that's on the company side and the issuer side, which is where the impact happens. You know, on the fundraising side and on the product side, I mean, I guess, you know, what kind of scale are we talking about in terms of your offerings and the cohort of folks that are offering public markets impact products?
Great set of questions. It's grown significantly in terms of those who are doing some form of this work. So today, in the U.S., it's estimated that there's about $8 trillion that's under professional management and managed this way, and the dollar amount on a global basis is about 3 times that. But importantly, what we're seeing in terms of the world's largest asset owners, whether it's the government pension fund in Japan, which is the largest single investor in the world, or the pension funds throughout Europe, the U.S. is coming along as well. These long-term universal owners are also really beginning to come onto the journey to determine how they're going to use their capital to create better outcomes for their constituents on an ongoing basis. So it's been a great period of growth. There definitely more participation, but we can clearly see the world's largest institutions preparing and beginning to take some action.
And that's an interesting point, because you do see a distinction between how Europe approaches this versus how you read in the headlines here. Some of the asset owners are issuing press releases that read almost like warnings to securities issuers, saying if you don't start integrating business practices of sustainability, you can kind of kiss our money goodbye. And so this is an interesting point I want to bring to Anne-Marie, who does represent 4.5 million European pensioners at the table, and get your take on what products are seeing the most momentum in your business. The motto I saw is that tomorrow is today. So it seems as though across the board there's conveyance of urgency and sustainability in what you're doing.
Yes, and if it's okay, I just have to make a short disclaimer before I go on.
That's fine. The lawyers run everything. We know that.
Yeah. So the views I express are my own and not necessarily those of APG. And APG provides investment advisory services to its parent and is not seeking other clients. So. In case anybody was wondering.
Check the box.
Yeah,
okay.
check the
We're
box.
done.
So now we can move on to more important things. So APG is the asset manager for several large Dutch pension systems. And as a pension fund, we're obviously focused on the long term and the generational compact that exists between current beneficiaries and the younger cohort. So it's with that we approach responsible or impact investing. APG has made a decision to integrate responsible investing across all its business units. So it's within the investment process. There's no standalone fund. It's just, as you said, a spectrum of how to approach impact investing, and this is the path that we chose. So we have a responsible investment policy, and as investors, we make conscious investment decisions. We know what we own, and we also are committed to engaging with companies who fall below our own ESG standards. So things that we might have been doing implicitly before the responsible investment policy are things that we're doing explicitly now. One of the other more important features is aligning with the Sustainable Development Goals. And we have what we call sustainable development investments that work our way towards those particular UN goals. Within fixed income, where I'm from, is the green bond market. And that has grown quite a bit from the early days, about 10 years ago, when it was basically a supranational type of issuance, into not only European, but US, China, Japan, et cetera. So it's grown out globally. And it's also now impacting corporate investments as well. So we're seeing not as many as we would like on the US side, but certainly corporate issuers being aware of green bonds. And while that's really important to address a lot of the climate and energy and environmental issues facing all of us, it's also a good signal for us when companies are issuing green bonds as part of a broader corporate social responsibility aspect. And within these companies, the people who work on green bond issuance are also very engaged and happy as employees, which is another signal to us that a company is providing a good working environment for their employees.
Mm-hmm. I mean, and is this a movement that you saw, as a groundswell from your 4.5 million pensioners, or did it come from the top down? I guess, how did it originate within a European context?
We're very fortunate in that our clients and beneficiaries have a very high bar for us. And so they're really encouraging us to set the standard out in the marketplace. So we do have that support behind us for these types of initiatives.
Okay. And is this a standard bar then for pension managers in
a European context? I would say yes, and I think in the U.S. side is slowly coming on board, but maybe a 5-10 year delay to what's happening in Europe.
But that's absolutely wrong. The U.S. is never behind in anything.
No offense.
So I guess I want to kind of pivot here to more the private market side. We've heard this convergence in the public markets, the scale that's growing in the public markets. And maybe I'll kind of spin to John Buley now. Prior to Duke, you spent 25-year career at J.P. Morgan. Very diverse career that culminated in leading the principal investing practice for the social finance group. And you've told me that those deals were the most difficult deals you ever did. And so, what were some of the challenges that you saw deploying impact capital through private equity vehicles?
Oh, well, first, thanks, Chris, and thanks for inviting me. Most importantly, thank you to all of you. And 2 observations. So I'm a professor now, and I wish I had as many people sitting in my classes not looking at their iPads. Last week, last day of classes was Friday, and everyone was just getting ready for graduation, so it's nice to see such an engaged group. Secondly, the first meeting of the Global Impact Investing Network was, I think, 2007, and we all got to the room. Calvert was there, and the entire room full of people interested in impact investing, notwithstanding hundreds of invitations, would have been only rows 1 and rows 2 of this group. In my wildest dreams, I did not think that the field would grow as quickly and as broadly and as rapidly as it has. As Chris said, it is very difficult. The origin story of impact investing is frankly microfinance, and impact investing was the offshoot of microfinance in terms of what can we do for more than just financial services for the poor. It was originally set, the original goals were by and large the private capital markets, where I spent most of my career. And private deals are by definition difficult to do because there's less market transparency, there's less market infrastructure. And in the transactions that I worked on in the early years of impact investing in 2008, 2009, 2010, the absence of there was a shared vision and shared goals, but we all had institutional biases that you can have people from big banks, people from foundations, as well as the United States government and foreign governments work alongside each other and get along perfectly well. But they have different challenges and different interests. And I think in the early days we did not appreciate that as much because we all thought, well, we're all nice people and we can all get along together. But there are different regulatory frameworks and others. And in the first, to work on a private deal in Africa with Chris that took about 2 years to commit $20 million with a lot of work by a lot of people to catalyze smallholder farmers in Kenya. That's really hard work. That's really hard work by a lot of people. But without that market infrastructure in the private capital markets, there was concern at the time, will this be made too easy so that the idea was initially that impact investment would be something separate from pure ESG and pure CSR. And now we're seeing a blending of a lot of different models, all of which are good. Added to that, we have, in addition to this transparency, a societal demand that companies and investors be more transparent with what they're doing. So impact investing also could not exist but for the societal demand for what does finance do in the marketplace to create value. So it's the dynamic and how this market has changed the last few years is, particularly in the private markets, how do we deal with those challenges in that there is much less data transparency? Not intentional, but there's just much less data transparency. And it's also very difficult to find investable opportunities while keeping in mind that some investors are seeking a return of capital. Some investors are seeking a return on capital. And some investors, and the words are used in very different ways, are grant makers. So putting them all together is much more challenging than one would think.
So everyone wants to do good in the world. I guess the challenge you're saying is coming together under a single banner or a single construct to do something specifically good. You can't get a number of institutions to agree on the metrics or to agree on the social impact they're seeking. I guess what was the challenge in corralling a number of big institutions? That happens all the time in the markets. I mean, syndicated loans occur all day, and people buy bonds all day.
Yes, and that's very true. And people buy and sell securities every moment of the day. But yet there's a market infrastructure that we all know that there's a bid offer on every bond and every public equity in the market. It's in the private markets, it's what is the goal and can you have too many goals? So if you put together a transaction and that really does create positive social change in the world, if some of the investors demand metrics purely on the environment, some investors demand metrics purely on the social goals of gender equality, racial lens, et cetera. And some say, well, we also need to show agricultural development. It is a constraint on the utilization of private capital, because if you're filling out different reports for 100 different investors, if I want to buy and sell a bond right now, no one's asking me for a report on what that company is doing. So private capital comes with its own challenges in that way.
So you've since moved on to Duke, and at your current perch, you can take on some of these issues from a kind of a research and an advocacy perspective. And so, I guess from a research side, what are you pursuing now to help scale the space? And secondarily, people are expecting the millennial generation to save the world. And through your teaching, I'd be curious, what are you imparting on these students that are coming to Impact with kind of open arms, and how do you see them shaping the future?
There's several questions there. One is...
be honest.
I'll let other people decide. Well, I had Chris as a guest speaker a few weeks ago, so he imparted things. I'm a professor of finance who also happens to teach social enterprise. I also happen to head the Impact Investing Initiative at the Center for Social Entrepreneurship at Duke. Duke was, I'll do the reverse disclaimer. Duke was one of the early entrants into this field through Professor Greg Dees 20 years ago, and Duke has been a leader in this field. A couple things. One, on what to impart upon the millennial generation and in business schools in general. If I have one mission in life in my banking and investing classes, it's to dispel the 1980s notion of the maximized shareholder value, greed is good at all cost. So in all of my banking courses, and I've noticed, again, I've been doing this 6 years, but MBAs are much more engaged in the world than when people who are my age. So that's very important, and you see that it's no longer there's students and young people who are interested, quote, saving the world, or what used to be said pejoratively as tree huggers. It's now people feel that the time is ripe for things to be for things to be done both. And I think that's great, because this idea of maximizing shareholder value at all cost was destructive in many ways to society in the last 30 years and has no basis in law or fact. The second thing that because of my interest is intense in the private capital markets, this field has been in existence for 10 years. We no longer need the cheerleaders that we needed 10 years ago. We need to confront some hard facts. And one is that the same principles of business apply and investing apply to social impact investing in the private capital markets as they do in regular investing. And we have to put some market infrastructure in place. And I focus my work, and I'm coming out with a couple of pieces in the next few months, on both governance of impact investments and social enterprises, because we all know that the governance issues, because it's a relatively small and growing group. And secondly, valuation. Because if, in the long run, if investors cannot value an asset, and they cannot price an asset, and there is no liquidity, we're back to the point of if we buy a bond but have no ability to sell it, and we're holding to maturity for 30 years, there would not be a robust capital market. Finally, and this is a question asked all the time, is why did, and some of it is just knowledge transfer. When I got involved in this field, most of what I learned was either through Calvert, OPIC, USAID, or go across the pond and Bridges Ventures, for example, in the UK. And I'm often asked by students, why is this so ingrained in Europe, and yet it's just more of a new field here? And so also trying to connect the dots to bring that over. But the valuation and governance issue, it's something we have to talk about, because 10 years ago, people said, well, we'll worry about that later once there's a lot of investments out there. Well, there are now, and they should be marked.
Interesting. You made a great reference to kind of the need to build markets and the fact that U.S. impact investment has grown within the last 10 years. And I want to come to Dave now, who runs the Overseas Private Investment Corporation, who's been active, I guess, since the early 70s in helping U.S. investors go overseas into very impact-forward strategies. And impact investing seems like a tremendous opportunity for a government agency, right? I mean, you can attract private capital to pay for things, reducing the public burden, at the same time increase service delivery. So I'd be curious how OPIC is viewing the impact investing opportunity.
Sure. Well, my first disclaimer is
oh, no.
I don't work for an oil cartel. It's OPIC, not OPEC. No, the Overseas Private Investment Corporation has a $23 billion portfolio across 90 countries, trying to advance development goals as well as U.S. foreign policy. And I think of us as the successor to the Marshall Plan. Right? The Marshall Plan, one of the most successful and impactful programs in American history to help rebuild Europe after World War II. And now we continue that tradition through putting money into private equity, political risk insurance, as well as in project finance. And so we do partner with, I partner with everyone on this stage at OPIC or in other lives, and we seek to catalyze money to those goals. Right? I want to thank the Milken Institute, Chris and Aaron and Mike, who, when I sat down with Mike at the London conference, I said, my goal in this job is to try and catalyze the trillions that we need for these goals. And Mike said, not only am I in, not only is the entire institute in, but 72 fund managers who are my alumni are in. And so if I can get that to work and the 80 people in this room to work on how we can get more money into this, I think we'll be able to promote the democracy and the development goals that millennials and everybody else wants to see in the world. And I think one of the ways we do that, there's a synthesis going on between the public sector and the private sector and NGOs to solve these problems. Right? It was Einstein who said, you can't solve problems at the same level of thinking as that created them. So we've got huge problems out there, and companies and the governments, there are no externalities between the world we all live in. And so we're all grappling toward how to fix it. And I think blended finance is part of that answer. And in particular, in blended finance, there's a role for everybody in this room and everyone at this conference, OPIC has a particular place in the capital stack where we can provide some of the political risk insurance that others aren't suited to do. We can also provide debt into projects. And I've seen that happen around the world, and we're going to continue to work with Milken and others to catalyze that.
Yeah. I mean, it's an exciting moment, and we are all in. And I love to have references to Einstein. It just shows we're an elevated group here. Of course. The best and brightest at the end of the hallway. I mean, in terms of international engagement and the role of government, the SDGs, the Sustainable Development Goals, were referenced earlier. 193 countries signed on to those. I think we all know that 193 countries around the world are not uniform in how they approach the world. And so as a U.S. government representative, how do you see impact investing shaping international engagement between kind of U.S. approaches, European government approaches, maybe Chinese government approaches?
Sure. Well, it surprises many people when I say that the Trump administration supports the spirit of the Sustainable Development Goals. Right? I can talk about the promotion of democracy. I can talk about our work across affordable housing, across healthcare, across power, in projects that support many of those 17 goals. And I think what's important to draw a contrast here is that the Marshall Plan empowered countries like Germany to, 2 generations later, to create their own Marshall Plan in Africa, which was announced last year. To be able to move countries into peace and prosperity is something that I think these companies and countries are uniquely suited to do in the West. And frankly, I worry about the global competition of ideas out there that are being manifested through other ways of investing. I've also started to explain to people that Chinese investment comes with a lot of red flags. Right? And as opposed to when we're promoting democracy, and I believe government of the people, by the people, and for the people, you see sometimes a different kind of impact that other governments are trying to have. And when you see ports being seized back and you see labor and environmental regulations below world standards, I think the West has a role to play there.
Mm-hmm, mm-hmm. And you reference, policy implementation. And, Jim, I want to come back to you on this point because you've been, active in a number of policy discussions as of late. And I'd love to hear your perspective on some of the policy issues you see.
Sure. I think there's been some really great developments in the policy area in the last few months. And in fact, there's still policies that I think are under development right now that have great impact in David's sphere with the Coons and Corker Build Act that would really broaden the authority of OPEC and enable it to essentially leverage in more capital through investments in equity and grant funding and other things that currently aren't part of OPEC. But I think on the other side, domestically, the Opportunity Zone legislation, which was part of the Tax Reform Act, creates an incentive, and I think the potential there is to really attract more mainstream investors to invest into distressed communities across the country. And these communities are defined by the governors, and I think there's a potential there for a fairly substantial amount of investment by deferment of long-term capital gains that would be given to investors that invest in opportunity zones. I think that's a great example. It's one of 2 proud moments of Speaker Ryan in his exit interview on CNN when he made his announcement that he was retiring, proudest moments. The other was CIPRA. CIPRA really focuses on establishing a fund at the federal level to enable the federal government to participate in social impact bonds or pay for success initiatives that are developed in the state and local communities. So these 3 pieces of legislation, I think, coming on in just the last few months really show, I think, a recognition by policymakers that this area of social good through private investment is one that's worthy of promoting and developing and collaborating on. And I think hopefully the OPIC legislation gets passed. I think it's looking pretty good, David, isn't it?
Yep.
This
Thanks
point.
to guys like you, it works for all of us.
So I think there's really optimism, and it's great to see the government here in the U.S. recognizing and coming on board and supporting these themes. And I think it portends well for, really the field of impact investing as we see, the stakeholders that are really going to be key to this get more involved.
Mm-hmm. I mean, so you referenced the BUILD Act, which is going to be incredibly important for development finance, and the bones of those policies have been around for a long time, and so in terms of kind of the runway time, I think that translates into some of the philanthropic work you've been doing as well, in as much as you could be investing or putting your name or putting your energy behind something that may not have an ROI for a number of years. So to kind of close out our continuum before we go to Q&A, how do you as a philanthropist kind of view the ROI on your direct investment portfolio?
Well, I think clearly we look at the mission or the purpose behind the money that we deploy, and that may not always be a financial return, although, I mean, we like to see a financial return because it means that an enterprise or an endeavor is meeting its goal on the social side. So, but clearly we look to support organizations or businesses or any type of activity that would help promote and raise the awareness to educate and facilitate impact investing. And I think that's really an important role that philanthropy can play. And in many cases, it may be in taking a concessionary return in a capital stack to help de-risk, to crowd in other funding. And in other areas, it may be in funding the technical assistance or helping to create or support an intermediary that is going to play a key role in facilitating impact investing.
I mean, so we've heard across this continuum, we're seeing a lot of growth, but there's no shortage of issues that still need to be overcome. You all have been a very patient audience, and I'd like to open it up and allow you an opportunity to chime in. So in the back is 1, and then you're 2, and you're 3.
I had a quick question in terms of, from the panelists, we see a lot of different mechanisms for actually creating these new blended financing vehicles. But how do you actually do it? So how does the DFID of USAID, Global Affairs Canada, with all your expertise on this panel, how do they actually create the mechanism to use their government funds for de-risking of foreign exchange or to work in some sort of blended financing vehicle for the emerging markets?
Dave?
Sure. We work with everyone from foundations to investment banks to really any sort of capital and political risk insurance, as well as project finance debt and private equity. And what I've seen in the blended finance space over the past couple of years is that most of those deals have been what they call bespoke at conferences like this. And so what we've tried to do is to create a platform where those folks can figure out what the blend is across a series of deals. And we actually, at Jim's conference in Utah, helped debut that with a number of the leading foundations out there, so that when you take 2 years to do a $20 million deal, hopefully we can reduce that time and be able to do 20 deals and be able to work together that way. But really, you've got foundations that are starting to move their corpus into the impact investing space. You've got impact investment arms of just about all the major investment banks and asset managers. And so I think it's only limited by our imagination how we can come together, but the U.S. government has unique pieces of that where we can pull together great origination, great due diligence, great monitoring, and political risk insurance that others can't offer.
I mean, on the public market side, I mean, we know that the government's active on the private markets side, but Anne-Marie or John, I mean, have you interacted at all with kind of government guarantee programs or other things to kind of de-risk your portfolios, or is that something that you haven't seen?
You want to take first?
Well, not on the public market side in that respect. Obviously, as was mentioned earlier, various social bond markets and green bond markets have benefited from the support of kind of quasi-government organizations, but no, it doesn't really apply in the public markets for us.
No, I would echo that as well. Certainly not on the corporate side, or when you think about reserve requirements for banks. That's been a topic of discussion for green bonds, getting better capital treatments, but that hasn't really gone anywhere. But I would say that from the government side, what we've seen in Europe is issuance from France, from Belgium, from Poland. So that's a pretty strong statement about commitment to these topics.
Issuances by the government,
yes,
sovereign green
issuance.
issuances?
Yes.
Okay,
yes.
so they're getting more active in that space.
Exactly.
But they're not slowing you down in terms of your deployment.
We're hoping they're not crowding out the corporate market, but no, they're...
And I've got a piece there also. Earlier this year, the U.S. government, through OPIC, helped the Ukrainians access the public bond markets here for the first time, taking their Moody's rating from about a C- to an A-, saving them about 500 basis points on the ability to keep nuclear storage or spent nuclear fuel rods in the Ukraine rather than paying the Russians $100 million to privilege. So there's ways that we do that through a wrap, basically the U.S. government and other governments sort of co-signing on loans for sovereigns that otherwise wouldn't be able to access these markets. And I'm hoping we'll be seeing more of that this year.
If I could, in addition, where the governments and DFIs, including people sitting at this table, have been so instrumental in moving the dialogue on in private capital markets is, given social problems cannot be solved in a 4-year investment period, 3-year exit period, the DFIs have been particularly willing to do things differently so that it's not just a private equity vehicle. And their research on the finance side, on de-risking private equity funds and creating alternative structures, we have found, I think in 10 years, it's difficult to use a traditional PE, VC. You can't create a Facebook or whatever. You cannot solve these problems in a year. And the DFIs have been instrumental in moving us away from the prior model of create a private equity fund, deploy capital in 2 years, get your money back, or in project finance, where it's 15, 30-year loans, which most of project finance in Africa could not have been done without the IFC, without OPIC, and with other DFIs.
Down in front, we have a microphone coming to you.
Yeah, so I wanted to follow up on Professor Buley's remarks. Wanted to follow up on Professor Buley's remarks about valuation in particular. Are you seeing people create financial engineering structures to drive incentives for investment? I'm specifically thinking about health and education derivative instruments. So ways to sort of change a double bottom line sort of structure to say, how do I drive education and healthcare in sub-Saharan Africa? What's a concrete measure of things that you might do that improve lives and add economic value, but to really turn that into a market instrument?
A very good question, thank you. The topic of the thesis of your question, I think, is what are those kind of financial instruments that will work? If I just said that private equity may not, in the traditional private equity may not. And the first is, let's not make things overly complex. I've worked with just about everyone on this panel on some sort of transaction in my prior life, and I still teach deals now. And we have to be careful not to overlay upon the transaction nature, making things so complex. They shouldn't take 2 years. So how do we make them less complex? Financial engineering in forms of derivatives have not yet played a part. Where I see financial structures bringing to bear is in where I'm most interested is in the United States, where you can create financial structures that have not been used to solve problems that did not really exist 10 years ago. The opioid epidemic, for example. I mean, that's where financial structures will help. But I urge people, take it from me, that the complexity of structuring, we're already dealing with some of OPIC and others are dealing, and Calvert's been doing this for decades, dealing with very complex problems. And the private markets don't have the kind of staff to analyze and understand and work on that in the same way. So I'm all for adding simplicity rather than complexity. Please.
One tool that is new to the toolkit are social impact bonds, right? The ability to pay for outcomes that are positive societal goods. I visited a Cameroonian eye clinic that the rate of return for investors will be better if they cure 18,000 people of blindness over the next couple of years. And that's a mix of foundation money, that's a mix of private capital, and we're seeing as this movement grows, more and more examples of that make it easier for lawyers and finance people to get their head around it. So I think social impact bonds are part of that structure and answer.
And we got to build the templates for those. I mean, I worked on one in India for maternal and child health, and I started work on that in 2013, and it closed 3 months ago.
Wow.
And I think
basic things like mortgage finance, I mean, that's probably moved a lot of people's lives in a positive direction. Crashes notwithstanding.
yeah.
But think about it for a second in that in the 1930s and 40s, the average mortgage loan in America was a 3-year loan. A 3-year loan that became immediately due and payable, which, you know, it was government intervention that started the FHA and said, you know, when I tell students that you used to have to pay back the money every 3 years. Well, of course, I tell students you used to have to put down a down payment, and they still don't understand that. But that's another story. But I digress. But the role in sort of having those templates, and in some ways, the rule of finance. I mean, and look, we're being sponsored by Mr. Mike Milken, who created the high yield bond market. And if there's one thing finance professionals are good at, is copying something that works. So once we find those structures that work, and the further development of pay for success and social impact bonds will be part of it. I yearn for the day where it can be like back 100 years ago when I was a lawyer. If someone wanted to do a bond deal or a credit agreement, you just pulled a document off the shelf. Right now, there is no document to pull off the shelf. And my goal for the next 20 years, if I'm able to, is that there will be something we can pull off the shelf.
I mean, so on the derivatives side, you know, there are a couple of products that are out there for currencies, you know, illiquid currencies, but those are very small and nascent. You know, these are kind of billion-dollar pools of money that are trying to manage 50 currencies, and it's just not up to scale. And so I think, again, it comes back to creating templates and creating data to provide the backdrop so you can price the risk in some of these markets that haven't developed yet.
But it is, if I could say in 1 second, it's very important. OPIC has been very supportive of MFX, which is the leading currency hedger for microfinance institutions. I never thought I'd have to give a disclaimer. I am an independent board member, uncompensated, for MFX Solutions Inc. But where they're trying to bring you know, the same kind of derivatives focus on currency and interest rates that have been around for 20 years.
I was just going to comment on the social impact bond. You know, I think the UK has taken kind of a different approach. They've created a rate card, basically. I mean, basically, you produce this kind of outcome and we'll pay you X, because they figured out what the cost savings or the benefits are, and trying to streamline and remove the complex transactional nature of social impact bonds. And I think there's a real you know, interest in trying to do that by taking those issue areas that are more mature and essentially prepackaging them into a transaction that can be easily done. There are funders that are interested in them. There are service providers that, you know, have experience and scale, and you know, governments are ready to pay for them. So I think it takes time. It takes building the infrastructure, and the ecosystem is very young. I think there are interesting funds that are being developed. You know, Line 17 is one that I think really has great potential, where it's really to, you know, packaging the due diligence, the investors, and essentially the pipeline to be able to invest into you know, various you know, sectors and geographies.
It's building that market infrastructure.
That's right.
To get the velocity of deals.
That's right.
John, did you want to?
Jim, you raised a very good point, and I think one of the critical aspects of the infrastructure that we need across all of these structures are standards, and to develop these markets and scale the markets, we need sets of standards, and we need sets of well-accepted metrics so that investors from this diverse set of backgrounds can come together and have devices to measure impact that we can pay for, whether it's social or environmental. I think the same thing applies on the public equity and the public debt side. We need accepted standards for companies to disclose under, to provide to us information about the impact that they're having on society and the environment, alongside of, maybe better than, the financial disclosures that they create currently. So as we think about this global development of these markets, and we really seek to scale it well, I think these are critical points.
So a gap accounting standard for impact, more or less.
Well, hopefully something less opaque than gap.
That's right. We have one more question down in front. We got a mic coming to you.
My millennial generation is sort of enthusiastically tearing down Friedman's idea of business as a means for shareholder, value maximization and nothing else. Deloitte did a super interesting study of 7,700 millennials and asked an open-ended question: what is the purpose of business? And a plurality, 47%, said some version of to improve society or protect the environment. So more so than said anything about making money. In addition to this, we have a $30 trillion wealth transfer happening largely from baby boomers to millennials. And so sort of two-part question is, one, will this have a sort of catalytic effect on the impact investing ecosystem? And if so, is there any additional groundwork that we need to lay to make sure that this enthusiasm is funneled wisely?
Yes,
I can make one quick comment. I hope that wealth transfer to the millennial generation, at least in my own personal experience, takes longer than expected. So, although my kids may be writing derivatives on me right now.
But I guess, in terms of your young pensioners,
Yes.
I mean, are they viewing and demanding different products than some of the older generations? Or are you seeing this in a different way?
Yeah, and it's not just the beneficiaries, the young cohort of beneficiaries that are demanding, like you said, doing well and doing good. But it's also, APG as an organization, wanting to attract the best and the brightest. And as an employer, to attract the best and the brightest in the millennial cohort, you have to have a good social responsibility aspect to your business. So it's also good business. I would also say that in terms of the generational compact, one of the things we have to be very sensitive to is, while we want to provide robust financial returns for the beneficiaries, we don't want to be introducing long-lived or tail risks to the younger cohort. So that's also part of our approach to responsible investing. What might look good today might not look good in 10 or 15 years, and that's incumbent on us as investors and asset managers to pay close attention to those risks.
Right, I think those are great points. But by the way, in addition to the $30 trillion wealth transfer to millennials, we've already seen $11 trillion in the U.S. transfer into the hands of women in terms of being primary decision makers, which is having a similar impact. When surveyed, women show an even higher response in terms of business purpose. But your question was, what do we need to have in place so this goes well? Well, certainly we need to avoid a situation where companies are greenwashing. Everybody recognizes these trends are happening. All companies really do. And so, again, in order to avoid a situation where companies are paying lip service to it in order to make people feel good without really creating change, I think it's critical that we link these activities to economic return. So even though the purpose of business really has to be greater than creating profit for the sake of creating profit, businesses globally still need to produce competitive returns for investors. And so so what is happening in terms of creating the groundwork so this can go well? First of all, academic institutions are now creating learning tracks and degree programs to train people about these issues. That just simply wasn't the case a decade ago. So that's critical. Our professional designation, the CFA in our business, is just really getting with it in terms of creating segments of the CFA exam that relate to understanding the critical role that businesses play in informing social and environmental outcomes. That needs to improve. Additionally, we need to reform certain fiduciary laws, primarily in the United States, to create clarity that it's acceptable to consider a longer-term stewardship approach when investing billions of dollars that are going to impact the lives of hundreds of billions or hundreds of millions of people around the world. So there are certain regulatory reforms that need to come, but I'm encouraged by what's happening academically. We need to kick the regulator into gear, primarily in the United States, and then training an army of analysts lies ahead of us, and we need our professional designation to go on. And I wonder if you have a comment.
Well, I think that, academia is catching up, and obviously and through Jim's good work in Utah and others, there's been a groundswell of change of views of what I'll call a younger generation, which means everyone younger than me. But we don't have to wait for all the baby boomers to die. I've already seen the impact. I've already seen the impact. I saw it when, in my prior life at a large bank, where the number of high net worth individuals who wanted to come speak to me, they're saying, where did you hear about this? And they'd say, my children. And where did you hear about it? My kids are talking about it. My kids are bothering me about what we should be doing. My kids are talking about this. And the millennial generation has already had a significant impact by catalyzing their parents and their employers, certainly. But they've already had a big impact. We don't have to wait for all of us to die before that happens. They're already pushing back to older people and to institutions and to governments to affect social change. And that is one of the most positive outcomes of, I think, of the educational shift in the last 10 or 15 years.
I mean, the implication of that question is that there's a convergence coming where impact is no longer, a side game. Impact is no longer a lens you put on top of something that already exists. It is what exists. And I'd be curious in our remaining 3 minutes to put that question to the group individually, maybe take 30 seconds each. Do you see that convergence coming? Do you see it in the near term where impact is the new normal? Maybe John?
Sure, yes, I think so. I have the privilege of participating on advisory boards for some large multinationals. And the reason I'm very encouraged is that actually big operating companies are changing their practices, partly because of the generational shift that's happening within these companies. In many cases, 47 to 50% of the staff, big companies, are millennials. And we've got women on boards, and we're creating some gender equality throughout. Things are changing. So I'm encouraged that the connection between these outcomes and business is being strengthened. And frankly, many large companies are ahead of Wall Street and the analyst community in terms of making themselves much more resource efficient and doing a much better job in terms of understanding the impacts that they're having on the communities where they do business, their employees and customers. Not enough, but we've got a good start.
Great. Jim?
I would also echo those comments. I think there is a tremendous demand. We've talked about the millennials, the next generation, and women. I also see more baby boomers that are becoming interested. When you have demand, you need supply, and we have unlimited supply of social problems to address. So you look at both of those sides of the equation, and they're there. It really comes down to building the ecosystem, building the infrastructure, and making sure that we put in place the kind of thoughtful, controls and protections and measurement that will help to guide the way. And I'm really encouraged by what I see.
Yeah, there's no turning back. So this is the state of sort of where we are now, this continuum, but it will be built on, and I can speak from APG's point of view that it will be strengthened and supported and go on, for forever actually. And the key part of all of this is education. So education not only to clients and beneficiaries, but also to counterparties, to customers, to colleagues. There's maybe a lack of sustainable skill sets out there right now, maybe in fixed income, and that all needs to be developed and strengthened. And as that happens, it will just become par for the course. This is the way business is conducted.
I agree with everything my colleagues said. 3 quick points. One, corporations, private and public, and governments are far ahead of the financial markets in understanding this, which coming from an ex-banker may sound strange. Second is, while we do this, while corporations and governments do this, we have to be very careful about the issue that was brought up earlier about the holding people to account with the potential for greenwashing. I'm not saying it's always out there, but the potential. We just have to be sensitive to that. But the financial markets have to catch up with corporations and with governments.
Yeah. Dave, last word.
We often talk about discounted cash flows and finance and sort of our prefrontal cortex. I think that investment decisions are also driven by hearts. I also think they're driven by my EFGH theory of the markets: ego, fear, greed, and herd. Right? And so as people think about these investments, they're not merely doing the numbers. And people are understanding that their money is a way of expressing themselves. And to deny that is to just deny behavioral economics. People want to do good with their money. People want to do good in the world, I believe. And this is a new way to express it. And I'm thrilled we're all part of this movement. And thank you for the opportunity.
Thank you.
I just want to say I think impact investing is growing up. Evidence that there are 3 legal disclaimers on the stage in this 1 hour alone. This is professionalizing by the minute. Thank you all for coming.
Thank you.